Welcome to the Deep Dive. We're here to filter out the noise and give you the key takeaways from interesting sources so you can get informed without spending hours digging.
And today, we're tackling something really fundamental in trading: risk management.
Exactly. We're using a great video from the Trade Room on YouTube featuring Mayank Raj as our source material for this one.
Yeah, and our goal here is pretty simple, really. We want to pull out the core principles Mayank talks about regarding risk.
But not just list them, right? We
Yeah.
want to understand how you can actually use these ideas to trade more sustainably.
Precisely. Make it practical. Focus on what really counts for, sticking around long term. And touch on the psychology, too.
Definitely. Without making it overly complicated. Okay, let's jump in. Trading. It always involves two sides, doesn't it? Profit potential and, well, loss potential right from the start.
It does, but what's kind of interesting and maybe a bit misleading is how social media often just blasts the wins, the huge profits.
Yeah, you see the Lamborghinis, but not the margin calls.
Exactly. It creates this skewed picture because the risk, the fact that losses happen to everyone, that part often gets, well, ignored.
So people might dive in thinking it's all upside without really getting how much risk might be behind those big numbers they see flashing on Instagram.
Having a realistic view is just so important. Losses aren't failures, they're just part of the process you have to manage.
Which brings us nicely to this next point, distinguishing trading from just pure gambling.
Oh, yeah, that's a big one. People mix them up all the time, but they're fundamentally different if you're doing trading right.
So Mayank breaks it down. Gambling, he says, is often like an all-or-nothing thing. You put down, say, 100 rupees on a bet.
And it's binary, right? You either win whatever the odds are, or poof, that 100 rupees is just gone instantly. Total risk on that one event.
Right. But trading, when you apply risk management,
Yeah.
it's not like that.
No, not at all. You're usually deciding to risk only a small slice of your total capital on any single trade.
Like if you have that 100 rupees, maybe you only risk 2 rupees, or 5, or maybe 10 on one idea.
And the goal is to make a return that's hopefully a multiple of that small amount you risked. It's calculated.
And this really highlights the mindset shift Mayank emphasizes, thinking of trading as a business.
Yes. Not a lottery ticket, not a get-rich-quick scheme. It's about strategy, process, managing your resources.
Because chasing those zero-to-hero trades, while exciting to think about, usually just means taking way too much risk.
And that's how capital disappears really, really fast. A business approach means planning, consistency, thinking long-term.
Okay, so we've got losses are normal, and it's not gambling if done right. Now, Mayank introduces this concept of 4 quadrants, 4 possible outcomes for a trade. I found this really clarifying.
It's a neat framework. Basically, any trade can end in one of 4 ways: big profit, big loss, small profit, or small loss.
And the absolute key takeaway here, the thing he really hammers home, is you have to eliminate the big losses.
He literally says managing risk to avoid those big hits is like 90% of becoming a profitable trader. That's huge.
It really is. And the math explains why, doesn't it?
It does. Think about it. If you have, say, 100 rupees again, and you take a 50% loss, you're down to 50 rupees.
Okay, simple enough.
But now, to get back to your original 100, you need to make 50 rupees on your 50 capital. That's a 100% gain.
Wow. Okay, yeah. Losing big makes climbing back incredibly hard.
Exactly. Whereas small profits and small losses, they kind of tend to cancel each other out over time, more or less.
It's the big profits, the ones you let run when they work, that actually grow the account.
That's the engine for growth. Keep the losses small and manageable. Let the winners be substantial when you catch them. That's the sustainable path.
Right. So how do we actually do that? How do we prevent those big losses in practice? Mayank gives a formula for figuring out your trade size, your quantity.
Yeah, this is super practical. The formula is your risk in money divided by your risk in points equals your net quantity.
Okay, let's use his example to make that concrete. Suppose you have an account with 1 lakh rupees.
And you decide, okay, maximum risk I'll take on any single trade is 2% of that.
So 2% of 1 lakh is 2,000 rupees. That's your risk in money.
Right. Now, let's say you see a trade setup and your stop loss. The point where you admit you're wrong and get out is 10 points away from your entry price.
That 10 points, that's your risk in points. It's the distance your trade can move against you before you cut the loss.
Exactly. So you plug those numbers in. 2,000 rupees divided by 10 points.
That gives you 200.
Yep. 200 quantity. So in this specific case, you'd trade 200 units of whatever it is you're trading.
And if it goes wrong and hits that 10-point stop loss,
Your loss is capped at 10 points times 200 quantity, which is exactly 2,000 rupees, your planned risk.
now seeing 200 quantity might sound big to some people initially.
That's a good point, but Mayank clarifies the absolute number. The quantity itself isn't the main thing.
What matters is the total money at risk.
Precisely. As long as that 2,000 rupees fits within your overall 2% rule for your account size, the quantity is sized correctly for that trade's risk.
So it's all relative to the stop loss distance in your account size. That formula keeps it consistent.
It enforces discipline on every single trade, preventing you from accidentally taking on a huge loss because you misjudged the position size.
Okay, that makes a lot of sense.
Yeah.
Now, this leads into something else Mayank talks about, which I think is crucial psychologically understanding losing streaks, using math.
Yes, the max loss streak. It's the reality that you will have periods where you just have several losing trades in a row. It happens.
Even with a good strategy.
Even with a good strategy, he points out you can actually estimate the likelihood of these streaks based on your strategy's historical win rate.
And he gave some examples, didn't he? Like even a 90% win rate strategy.
Yeah, statistically, you might still hit maybe 2 or 3 losses consecutively at some point.
And if your win rate is lower, say 70%,
Then you might expect streaks of maybe 4 to 6 losses.
and a 50% win rate, which is pretty common for some strategies.
Could potentially see 7, 8, 9, even 10 losses in a row, statistically speaking, over enough trades.
Oof. 10 losses in a row sounds rough.
It definitely feels rough.
Yeah.
But let's see the impact using our example. 1 lakh capital. If you stick to that 2% risk, so 2,000 rupees per trade, and you hit a 5-trade losing streak.
That's 5 times 2,000, so 10,000 rupees lost.
Right, a 10% drawdown. Not fun, but manageable. You're still very much in the game.
Now, what if someone was risking, say, 10% per trade? Which sounds crazy, but people do it.
Yeah, chasing big wins fast. So 10% of 1 lakh is 10,000 rupees risk per trade.
Okay.
That same 5-trade losing streak, that's 5 times 10,000.
50,000 rupees gone, half the capital.
Exactly, a 50% drawdown. Recovering from that is a massive uphill battle, psychologically and financially.
So just knowing that streaks are statistically normal, even expected.
It helps you prepare mentally. You're less likely to panic, less likely to ditch your plan or start revenge trading when you hit a few losses if you know it's part of the probabilities.
It normalizes it, in a way. Takes away some of the fear.
Totally, which loops back to that core rule Mayank keeps stressing.
Never risk more than 2% of your capital on one trade.
Never. He's really emphatic about that. Doesn't matter how sure you feel, how high you think the win rate is.
Even with 90%, like we said, streaks happen.
And if your win rate is more typical, like 50 or 60%, then that 2% discipline is even more critical because longer streaks are just more likely.
And this ties into the risk-reward idea too, doesn't it? Aiming for winners that are bigger than your losers.
Absolutely. He mentions aiming for like 1 to 2 or 1 to 3 risk-reward ratios.
Meaning, for every 1 rupee you risk.
You're aiming to make 2 rupees or 3 rupees if the trade works out.
And if you do that consistently, you don't even need a super high win rate to be profitable overall, right?
Exactly. If your winners are, say, double your losers on average, you can be profitable even winning slightly less than half your trades, mathematically speaking. But it only works if you keep those losses strictly controlled with that 2% rule.
So the small losses are contained, and the bigger wins pay for them and then some.
That's the mathematical edge you build over time. Risk management creates the foundation for the edge to work.
Now, he did briefly mention a formula for estimating the max losing streak for the math geeks out there.
Yeah, he gave an approximate formula, log, divided by log 1 divided by win rate, where it is like the number of trades.
Sounds a bit complex, maybe.
It is a bit, and he stresses it's just an approximation, not a guarantee. But it provides a sort of mathematical basis for why those streaks we talked about are likely for different win rates.
So, again, it's reinforcing that losing streaks are statistically predictable to some extent.
Right. It's not just bad luck, it's probabilities playing out over time.
And knowing all this, understanding the math, accepting losses, planning for streaks, it must have a big psychological benefit.
Huge. It takes away a lot of the fear and anxiety that can cripple traders.
When you know your maximum loss on any trade is limited, when you know streaks happen but won't wipe you out if you're disciplined.
You can approach trading more rationally, more calmly. Stick to your plan even when things feel choppy.
Because, as Mayank wraps up, using these basic math principles for risk management is what really protects your capital.
It's what keeps you in the game. You need capital to trade. Risk management preserves it.
So you can survive the inevitable drawdowns and be there to capitalize when your edge does play out.
It's all about longevity. Consistent, disciplined risk management isn't just defense. It's what enables long-term offense, long-term success.
Okay, so let's just quickly recap the essentials from this deep dive into Mayank Raj's insights on risk. First, trading has both profit and loss potential. Accept it.
Second, treat trading like a business, not a casino trip. Big difference.
Third, those big losses are killers. Avoiding them is priority number one, like 90% of the job.
Fourth, use that formula risk and money risk in points. Quantity to size your trades properly and keep risk consistent.
Fifth, understand that losing streaks are mathematically probable. Know what your strategy might expect.
And finally, the golden rule. Never ever risk more than 2% of your capital on a single trade. Non-negotiable.
Applying these consistently, that's the path to protecting your capital and hopefully finding success over the long haul.
These are really practical tools, not just theory. Using them diligently can make a massive difference.
Definitely. So maybe a final thought for you listening. Reflect on your own tolerance for risk. How can you start applying these ideas, the math, the psychology, to whatever you're doing, whether it's trading or any decision involving uncertainty?
Because making informed choices and protecting your resources, well, that's always a smart strategy.
Couldn't agree more. Thanks for joining us on this deep dive.